Hi, this is Randy Finney with the right side of the chart, and today is Monday, June 21st, 2021. What we're going to cover is a brief update on the major stock indexes. Then we'll roll into some of the things we've been highlighting recently, the financials, gold, the dollar, commodities, crude oil, AMC, and I also want to include lumber, do an update there. Been bearish and short lumber for a while, but getting ready to, I think it's poised for a nice counter trend bounce, so there's a trade set up there. So time to maybe cover shorts. I'll give you the levels to watch on that and or go long. All right, so SPY, S&P 500. This is a daily chart. There was the secondary trend line right there. There was a primary trend line break back here. That goes all the way back to last year, the March lows. Breakdown back to same story. Today we're just, market's up, but to me this is just a kind of a reflexive bounce and also an expected bounce, or at least not shocking. Remember on Friday we had not just XLF, the financial sector hit key support. It was my first price target, but quite a few other things also fell to support. So this is a typical reaction, and with that we have just about everything else bouncing. I'm showing all 11 sectors right now in the S&P positive. I'm going to show you what some of those look like here in a second. So that's the daily chart on SPY. But where does it stop? I do believe it'll stop, and I think actually this is a nice shorting up. You have a gap. What I'm doing here, you can see it on the daily chart as well, but on the 60-minute chart it shows real well. There's a gap right there. That gap down on Friday, and so the top of the gap, let me give you that number right now. If you're a SPY trader, that's about, give or take, call it 140, 420, 150. But when shorting a rally back to backfill a gap, I always like to go in a little early. If you took longs of Friday when the financials hit support and some other things, and you're taking it for a quick bounce, anywhere from now up into that level seems objective. And likewise, if you just want to put a short trade, whether it's for a much bigger leg down, I still think we're going quite a bit lower, or you just want a quick pullback trade, you're trading actively, again, my suggestion would be to put it in a little bit shy of that 421.50-ish level right there, because I do expect that will most likely stop the rally. And the trend line, we'll see it here. Well, let's go over to the 60-minute chart of the futures. There's our uptrend line, nice and clear on ES, the S&P 500 futures. There's our rising wedge pattern. There was our breakdown, our sell signal, and again, this is so far, again, has all the makings of a downtrend, which is downtrend is simply defined as any security making a series of lower highs. So if we turn down on or before we get to that previous high from last week, and also lower lows, and that's exactly what we have in the S&P 500, and it comes after the breakdown. And again, this wasn't just a run-of-the-mill drop out of nowhere. It came right after the break of the uptrend line there on the 60-minute chart. So that's that. And then comparable levels, if you are a SPY or ES trader instead of SPY, 422.23, give or take right there. That is that resistance level defined by these previous reaction highs there, quite a few right here, and one right here. You also had reaction high from above. So that to me is a big level. Again, that's 422.23. I can't promise we reverse from there. I think we will, but what I can promise you is that I believe that this is an objective shorting up. Right now, we're close enough to it, and to me, it's so obvious. And the way I look at the charts, usually when the more eyes that see a level because it's that obvious, typically you better chance that the sellers are going to step in early. And so even if they don't, you may overshoot it briefly. That'd be a momentum overshoot, but we're talking a very small range. So you short here with a stop above, and if you're bullish, you want to see a breakout of that level. Yeah, sustained breakout, and then of course a break of the previous highs, and there's really no resistance overhead after that. All right, so that's that. That's my preferred scenario. We already hit, this was a target that I had here from before, 41.31. We hit it last week, and since it was already hit once, that's the typical reaction off the tag of a price target or support level, and so therefore I favor the next leg down, coming back to down here to at least that 41.04. We'll call it 4100 support. there was some RSI divergence in the on the 60-minute chart right here from that point to that point, but we didn't have any divergence here on the PPO. That's something I look for to help identify a more significant rally. So I still view this as just a reflexive bounce. NQ Nasdaq 100 last week or for last week or so, when I've been highlighting this chart on the 60-minute chart, I had this trend line here. We had this knee-jerk reaction to the FOMC meeting last week, and but that in itself gave us another reaction. So what I've done now, I think you can see here on the chart, is I've added a secondary trend line, which to me now is a better fit. This one no longer is valid to me because it's been chopped through too many times, and so I just wanted to show it to you. To let you know that was the one from before. I'm going to remove it now. So here's our trend line. Just come draw off these lows right here. What is that? May 19th, that reaction low, and it comes in pretty clean and picks up these additional reaction lows, and that's the one that needs to break. The reason that I'm more apt to wait for a break of that for a sell signal on the Nasdaq 100, the next objective short entry, than to go long on pullbacks to it are these divergences. Sooner or later, most often these divergences will play out for a trend change as they did back here. And so that's what we need to see go right there, that trend line. First target, and that's a high probability target. If we break the trend line, it means I would put very good odds that that will be hit, and I'll also put pretty good odds we'll get a reaction there. So if you want to actively trade, that's around 1376, 13,737 that level's at, give or take right there. And then the next target, more of a target zone, is down here, runs from about 13,455 down to about 13,377 right there. So we'll call that T1, target 1, and then we'll call this T2 zone right there. Make that a 2 or a zone, whatever, target zone, whatever you want to call it. All right, let's get to the fun stuff. Because with the markets doing this grinding thing in one sector, taking the baton. I talked about that recently when I was waiting for the sell signals on the financials and industrials, and those recently came. But as I pointed out, once we got that, as expected. And this is the pure play. You can short the S&P. I always talk about this, but you're shorting or going long if you're bullish all 11 sectors at once, and there's usually going to be one sector going up, others going down. There's defensive sectors, high growth sectors, and because of that mix and that diversification, it helps to smooth out the bumps, and that's one reason the S&P 500 index funds are so popular, because of that diversity, and therefore you're not as volatile as if you're trading one sector. So I would say, lately, the trade has been to be short, the most bearish sectors and long the most bullish. But what we've seen here, as I mentioned before, when we got the sell signal, came right there, nothing but red sticks. Friday, as reported, we hit support, my first target. So this is that, again, reflexive bounce. Where to? Well, there's a gap there as well, and that's probably the stopping point, or I would say my bounce target range if you're trading XLF and you're looking to either game the bounce or get back in short, is from about right here. So it would be the bottom of that gap from Friday morning. We gapped down. So the top of that gap, so where we closed on Thursday before that, up to about this level right here. I see quite a bit of consolidation. We'll call it 37.50. And so that's XLF. You also have XLI, the industrials, which broke down. They're bouncing today in sympathy with the market. Oh, and also, I think I mentioned this last week, the S&P 500 as well hit the 50-day. I talked about that. Yeah, I believe I did recently. And the 50-day moving average, that's the yellow line. I think you can see it here. It often acts as support and uptrends, as you can see here each and every time. So it would be unusual to see us just cut right through it. Not completely impossible, just the odds favor at least a small bounce on the initial tag. When I say initial, it means when you haven't hit it in a while. Here we're two close, near consecutive tags close by, but every now and then you come and visit it. So, as I always say, if you're bullish and you've been waiting to buy into the S&P, there was your chance on Friday when we hit the 50-day moving average. But based on everything I've already talked about, including but not limited to the negative divergences in place, I think that it's a matter of time before that goes. These are the divergences I'm talking about here on the daily time frame. All right, I believe that I hit the pause button and I thought I was recording, so I'm just going to revisit what I was just talking about. The 50-day moving average on SPY, I'm going to turn off these lines right here. That was the other thing. We hit the 50-day moving average on Friday as well, and so again, that increased the odds of a bounce. This is the yellow line right here is the 50-day moving average, so there it was hit on Friday. It was hit here, here, and that's where buyers usually step in, especially on the initial tag from above. Sometimes you'll trade on it for a while, and so what you're basically looking for now, if you're a bull, you buy pullbacks to the 50 or other support levels, and if you're waiting to short, you want to get a short trade on SPY, wait for a solid break below there, and so that would pretty much be a break and close below Friday's lows right now, or put up a 50-day exponential moving average on your chart. I think you can see it there in the video. It's that yellow line. Okay, now I believe, and again, I don't know exactly where that pause button didn't come back, where I didn't unpause the video, but I was talking about the recent rotation, and we have to, that's something to be noted as financials were going down, XLF, after the sell signal. We also had money rotating into the tech sector, which is overall, I'm going to call it a healthy thing. It's certainly not bearish. It's bearish to see the financials drop, but when you have one sector or a couple going down and then money is going into other sectors, that's what's kept the market up. So I'm going to keep an eye on this one. This is XLK. That again shows you it's been running up recently, and that means money's been, institutions and individuals are simply rotating out of tech. I'm sorry, out of financials, which were due for correction, and into tech, which has been lagging behind overall. But again, the fundamentals haven't changed. This is turn on all my lines here. Here, let me turn them off and make it a little more clean for you. We've been diverging for a while. These indicators, this is a daily chart, been making lower highs all the way to this point, and with prices making a higher high or equal highs, and we could go up a little more. I can play around with this line right here as long as the these divergences remain intact. That indicates most likely we're going to get a more significant correction in the in XLK. Okay, let's move away from there because again, trading the broad market, unless you get hit and run in these sectors right now, overall the S&P 500 just continues to be in that sideways grind now for quite a while. This is what it looks like on a 60-minute chart, just kind of moving sideways there. All right, so money to be made. I told you last week I would really like gold for a re-entry on a long-term trade. Gold hit the top of my buy zone, long-standing buy zone right here. I need to extend it out. There it is. And so the case has been made for a long re-entry back into gold positions for both a swing trader as well as a long-term trader or investor. Pointed out again, we also hit that oversold or 30 level just below the 30 line there on the RSI, and that's typically, and these moves down to the blue line right there, that's when you want to be buying a security, particularly gold, in a bull market. You bought there, you bought there, and you had a nice trade, you bought there and you bought there, and here we are. So only time will tell if it works out, but that's what I'm looking at now. And if we take another jog down, get in my buy zone, it's still a buy. You can scale in up to or down to, but not much below 158 or so. So that's what it looks like there for you gold futures traders. This is GC, as I mentioned, I believe I mentioned on Friday, we had some nice divergences setting up, potential divergences. We didn't have them early on the first tag, but we did. We had a little rally up and then another thrust down to put in pretty strong divergences. They're not very long, but they're very steep. Look at the slope of the trend line below the indicators down here, the RSI and PPO. Again, that is a 60-minute chart of GC gold futures, and you also had some nice support down here as well in this area, about 1753 up to about 1765, a support zone, and we kind of went right into that. So, and look, if we take another thrust down, ideally you want to see support hold. If it doesn't, support doesn't always hold. I'll have to show you the next support. It'd be around here, about 1730 or so. And what we'll watch, and I can tell you right now, if gold did take another jog down early this week, to around that level, we're still going to have positive divergence in there. So this is more of a micro outlook. I'd rather be, in now, scaling back in now, which I am, than to not miss a run up. If we do take that other leg down, I left enough dry powder to add to, but if we break that level, let me put the line there, just so I can revisit this in the next video. Yeah, I really don't want to see gold go for now for at least a swing trade. Nothing changes on the long-term chart, that daily chart of GLD I start out, but for a swing trade, it would be ideal to see gold remain above that 1725-ish level right there, that support, and keep those divergences intact, like I talked about there. So this is my preferred scenario, and this is my alternative scenario right there. Anything much more than that, at least for a swing trade, my preference is to let it go and then just wait till the chart's set up again. Okay, and I usually factor in the outlook for the US dollar in my analysis for gold. And a couple months back, a few weeks back, I was bullish with this bullish falling wedge pattern, 60-minute divergences, looking for a counter trend rally in the dollar, which we got, went on, hit and exceeded my maximum preferred bounce target, which was 91, about almost 92 on the dollar, US dollar futures DX. This is a 60-minute chart. And so just recently, just like gold put in that little divergent low, remember we put in a nice little divergent high here on the dollar. And so far, pretty impulsive reversal. And so I think the dollar is coming back to at least that 373 level, and if so, that should be a boost for gold. And quite possible that this is it. I remain longer term bearish on the dollar. That may be the end of the run. In other words, all we're going to get out of this divergent low, and we could see the dollar go on and ultimately continue on to make new lows, new multi-year lows or multi-month lows, and that would jive well with the call on gold, bottoming out here recently, and another leg down in the dollar, another leg up in gold. And silver, of course, and the mining stocks. Crude oil on that 60-minute chart. Remember, we broke this trend line last week. We had a divergent high when we did so. Breakdown back test, thrust down, and we have a kickback rally that is now back testing once again. We had a back test immediately after breaking down right there, and this is just the second back test. And I'm still maintaining this target of minimum target of 66.61. This back test also has just taken the divergence we already had in place and made it just a little bit larger now. So we extended the negative divergence. It's still very much intact, and I think this is an objective area to short. Thing about shorting back tests, sometimes you continue to back test, you have another back test, but again, based on where I think we are and where I think we are with the S&P 500, that's my preferred scenario. So I do think it's an objective short there, right here, with a stop somewhat above on crude as we're back testing, minimum target 66.61. And commodities as a whole, still, I told you last week they hit that trend line, which was the target from the last time we were at the top of the price channel there, followed by a sell signal on the break of the uptrend line and that divergent high. So same thing, you have a gap overhead, and I remain longer term bullish on commodities, but just at this point in time, hard to say if there's going to be a little more downside before we make the next major leg up, and if so, as I said, that would be a support level I'd be very interested in stepping back in. And of course we'll look at and I glanced over the commodities today. Some look okay pulling back to support, but I'm just not crazy about the charts. Being there in a bull trend, you step in and you buy the trend line with a stop below, or like I said, with the divergence you can stand back. I don't think we're going to have a runaway move in commodities right now. It is possible, but I doubt it. I still think there's, maybe a little more profit taken or consolidation to be had here after the pretty strong run we've had. Okay, and in that commodities arena, we have lumber. Lumber futures, LB, that we go all the way back here. That was our sell signal early on, break of the minor trend line right there. And then we went on to break the even larger, more significant trend line right here. additional sell signal. And since then, since this high right here, we've been in a downtrend again, downtrend series of lower lows and lower highs. However, you can see these little along the way. You get these little trend lines. There was one right there. I don't know where it went. I had one drawn there. Let me put it back. There it goes. You get these little trend lines, and that was, remember, that came early on in the top, and then we broke the parabolic trend line, so that was a more potent or more significant sell signal, and we've had almost a 50% drop in lumber futures. I talked about that quite a bit. Lumber goes parabolic. It's always done this, and then when it breaks that parabolic trend line, you have a near vertical drop, a very sharp drop, and a powerful correction. And there may be more downsides. In fact, I suspect there quite likely will. Hard to say, but all I'm talking near term right now is a buy signal to come on the break of this trend line. It's nice, clean, well defined. That one we didn't go too far, but that was still almost 10%. I think that was 9.5% if you took it on the breakout right there, and that one was even greater right there. This time around, where do we go? I think we might come all the way back up here to the 1195 target, and if so, depending on where and when we break out, and if and when we break out, you're talking about a 27% run in lumber futures, and that would be tens of thousands of dollars, I believe, in profit. It's a pretty big contract size, and unfortunately, to the best of my knowledge, there's not a mini contract for lumber futures. One proxy, and I've shared this many times in the past, are wood and cut. Those are two ETFs that hold not lumber futures like a lot of the ETNs out there. This holds a basket of timber and forestry companies, and I was highlighting this one for months along with lumber, telling you once lumber cracked, that would be a short, and your sell signal would be a break of this trend line, and that we had it right there. There was a beautiful, we were diverging, negative divergence, building, and then there was our top right there, that little doji candlestick island top. You have a candle right there separated by a gap on both sides. That is a nice topping pattern, and on the candlestick then you had the sell signal on the break of the trend line, and from there, from the top, wood fell high to low about 15%, and from the trend line break right there it was about a 9-10% drop. And there's cut right here. So either way, if lumber rallies, they're probably going to rally, so it's probably a little more upside in these, but ultimately I see more downside. This is cut. It's just another company holds the same, a similar basket of timber and forestry companies. There was your sell signal. I should have a line, which I'm going to add right here. That's where it bounced. See, I put that there because you had these reaction highs, and of course you have a reaction today. So probably a trade to be made on the long side. I prefer lumber futures myself, but after that run is up, I think cut's going to come on down here to that about $35 would be my next target, and then if that's taken out, all the way down here to about 33. So those are some near-term swing targets. And again, might be a little more upside if lumber breaks that downtrend line on the 60-minute chart I talked about. You have a comparable or a similar trend line right there as well. But ultimately, I think that's just going to be a counter trend bounce and another leg down. So there's some trade ideas for you there. And finally, last but not least, AMC. I continue to update that one. There's a lot of interest in it and also a lot of profit potential. It's just holding up, and it surprises me. They haven't been able to, there was a big run there, but the big run that the Reddit folks are talking about, they think the stock's going to 100 or more. It hasn't materialized, and we are below this trend line right here. However, we took out the trend line. You can see it best on this 15-minute chart right here. And it's just not an impulsive sell-off. It's just a lot of sideways trading. But your big level remains about 64 and change. You can call that 65 if you want. We're below the triangle, so I favor this move down. What it seems like here is that Reddit group, and they call themselves the Apes again. They're sworn to hold together, band together like Planet of the Apes. They're holding their shares. They're not panicking out yet. But what I'm seeing here, I think it's like a vacuum just sucking up all the buying pressure, and the momentum has clearly waned. We're going sideways now. So while they're not selling, you don't have enough new buyers coming in to lift the stock and trigger that short squeeze. Nor do I think the stock is as heavily shorted as they believe it is. And even if there is a high short interest, the commercial traders can be protected in other means via derivatives and stuff like that. So that's that. I still think we're going down from here, and my targets remain. These are just initial targets. Let's just say down here to 37.63 and then 32.22. And then if we start heading down to those targets, I think it'll be clear that they're not going to pull off their grand short squeeze, mother of all short squeezes, and then we come back down. Still believe to at least 14.32 is where I have that level, and quite possibly all the way down to around $9. And those are pretty aggressive targets. Again, don't trade a company like this if it's not your cup of tea. And other swing targets be about $20. We have the uptrend line. So if you do take it short and you have some big gains and you're worried about, you want to lock those gains in, a drop to that $20 level and uptrend line, that alone from where we're at right now would be a drop of about 66%. Nothing wrong with covering there, especially if you're short, because when you are short, that's the bulk of the gains at that point. The stock can continue to fall, but it's on a decreasing position size unless you add it to your short position. If you short it, in other words, short 1,000 shares, it's round numbers at 56 where we're at now, that's 56 grand. But when you get down there, your position's only worth 20,000. So you cover it and you book that $36,000 profit. But if it drops from there, another, let's say 50% at that point, then $20 goes to $10. You have $10,000. You only made another $10,000. See what I'm saying? It's, at that point, you either add to the position, which I'll sometimes do when a short position starts to build some steam if I have longer term downside targets, or you take the profits and move on to the next one. Or the other option is, if you catch it and you think this one's going to zero, like some of the analysts do, you just trail your stops down. You ride out the counter trend rallies. Like I said, if we get down there, if we get below this level here, all this recent trading, I can see on the volume of the histogram bars. You might not be able to see them on my chart. I have the colors tuned down. This is where a massive amount, most of the buying, you can look at the chart and see all the buying recently, but there's a tremendous amount of money. And when we start getting below that level, all those apes that swear to hold the stock till it hits 100 or bust, they're going to start to second guess that. They're going to see losses mounting in their account, and they'll throw in the towel and move on to the next meme stock. That's my guess. All right, we're going to wrap it up here. And if I see anything else before the end of the day, I'll get something out to you. If not, we'll pick it up tomorrow. This has been Randy Finney with Right Side of the Chart. Have a great day.